Hi everyone, my name is Michelle Schneider and I am the Director of Education Research at MarketGauge, co-writer of the Complete Swing Trading System, and producer of Mish's Market Minute Premium. By now you've all received in your inbox the 3 rules of successful swing trading. What I'd like to do with you today is cover the first rule, trade with the wind at your back. We will be examining phases and how, regardless of the volatility that has happened over the last 10 years, as you can see illustrated by this S&P 500 monthly chart, I'm going to show you that we can make money, take advantage of this volatility, whether the market is going up or down. I'm going to show you how to feel comfortable and safe in taking positions home, regardless of whether you are a trader part-time or full-time. I will also let you know, according to these phases, when the market is in a mode that is easier for you to swing trade. So it doesn't matter whether or not you start with a small account or an IRA. We're going to show you how you can avoid the big losses and consistently build on that account, taking advantage of these market phases. So where has the traditional buy and hold mentality gotten you over the last 12 years? Absolutely nowhere. Had you bought the market at the beginning of 2000 for a buy and hold, here you would be as we start 2012, still down money. In fact, at the end of the month of October in 2007, it actually took out this high and trapped a lot of people long, and not only are they still losing money, but they had to sit through a lot of pain and have yet to experience any pleasure. But what you can see from this chart is that if you know how to trade phases and momentum, you had a really great down move followed by a great up move, another down move, and then over the last couple of years, another really good up move. So the point is that if you understand phases and how to trade phases, if you understand that you can make money in up or down markets, if you're no longer afraid of taking positions home because you've entered with very reasonable risk and you understand how and what you're looking for your targets, the last 12 years would have been extremely profitable for you. And it's with that in mind that I'm going to take you through the phases today. So I'd like to go back a little bit in time to the beginning of 2011, end of 2010, and show you that the way we control risk is not necessarily waiting for the market to go into bull phase or into a bearish phase, but we use these phases in between, of which we have determined here at MarketGauge that there are actually 6 different phases of the market. And furthermore, that when the market is changing from one phase to another, it is often the most powerful time to trade, catch some really great momentum, and do that with a very limited amount of risk. So you can see here on the chart that when we go from a bullish phase, once things start to deteriorate, we call it a warning phase, then a distribution phase, finally here we are in the bearish phase, and conversely, when things are going from a bearish and starting to improve, we go back to a recovery phase, then an accumulation phase, and of course finally into a bullish. So if we just look at the last couple of years, we've actually been in every single one of these phases. But what I'd like to do is take you a little bit on the journey from how we started 2011, what happened as we got into the end of 2011, and show you how these particular phases right here, the recovery and the accumulation, as we were going into ending 2011 and going 2012, gave you some of the greatest trading opportunities. And I'm going to show you this example using the S&P 500, and then I will show you the same type of example with a couple of stocks. Now, as traders, we use lots of different indicators to time our way in and out of the market, and all of these are covered in our complete swing trading system. But for simplification purposes, and in terms of our phases, the 2 leading indicators that we use are both the 50 and the 200-day moving average. So the blue here, this is the 50, and the green here is the 200. There are a couple of factors that we look at in terms of where the price of the market is relative to both the 50 and the 200. One would be how far the distance is from the moving averages and the price. So for example, here where it's above the 50 and starts to break the 50, you're getting the price right here, which you'll learn by the time I'm finished here that this was actually a warning phase and a good indication to start getting out of longs. The other is what the slope of the moving average is. I like to see that if the slope is inclining and on a steady incline, that usually it means the momentum of the move is stronger, whereas when the slope starts to decline, it means that the move is actually getting weaker. That's number 2. And number 3, of course, is which is the stack, which means basically is the 50 over the 200, is the 50 under the 200, is it crossing, etc. And then whammo, back in this period right here in May, we started to break the 50. So if you recall on the circular graph, and if you look back at the report that you were able to receive in your inbox, you'll note that when this happens, we call this a warning phase. Warning meaning that the bullish phase is starting to wane. Warning, it might be time to get out. But you can also see that at this point we still held the 200-day moving average and then finally broke the 200-day moving average back here. So if you hadn't even sold here, you certainly were starting to look at getting out of your profit targets right here, especially if you'd been holding for quite some time. Now as we go along here, you can see that we went from this bull to the warning. When we break the 200, what we call distribution, we kind of chopped around here, and then whammo, back in this period of time in July, we wound up getting a death cross. So at the very least, what you were being told, just as a trend follower at that particular time, that it was probably time to be extremely cautious in terms of being a long-term buyer in the market, and that whatever profits you had from stuff you might have bought earlier in the year as we began 2011 was certainly time for you to manage by raising stops. And we find this to be an extremely critical way to not only make sure that you're not buying just because something has dipped, but that you're also protecting what you had already bought so that you don't wind up losing money. Now moving on, once we got to death cross, you can see the slope on the 50 was negative, the slope on the 200 was still slightly positive, and by the time it happened the price was down here. So remember I said that the third thing I like to look at is how far the price is from where the moving average action is, and you can see that's pretty far. So that would have certainly prevented me at this particular time from going short, but it certainly would have equally prevented me from being an aggressive buyer. Now as we move on here and we start to end 2011, you can see what happens. Again, we get actually, if you are a good chartist and you understand price action, you can see that we start to find a lot of support down here, and then here we go. Back before the beginning of October, we get back over that 200-day moving average, and we call this now where it first got over the 50 and then back over the 200. We went from a bear phase to a recovery phase to an accumulation phase. And I know this is a lot to digest, but what I'm really trying to tell you is that once you learn these and you really understand these very intuitively, and you have a set of rules to follow based on what we teach you in the course, this becomes an extremely powerful set of rules for you to follow for timing your way in and out of the market. So now let's move on to see what happens here as we get into the end of 2010, and we're now getting back to a situation where just the opposite happened from what had happened earlier with the death cross. Now we're getting a golden cross right here. So all of a sudden we had gone from this recovery phase, so had we been looking to buy against this price action here in these bottoms, we would have bought over the 50-day moving average, which means that we would have had a tremendous advantage now of getting into the market somewhere along these price points or somewhere around 110, and then using the blue line or the 50-day moving average as our stopping point, because we certainly want to be long on a recovery but not necessarily if that 50-day moving average breaks. So that is an extremely important lesson to learn as we look at these 6 different phases, is how we time our way in at the absolute lowest possible risk, so that by the time this death cross happens and then we get into October and now we're in November, we're not only long at 110, but up here where other people might be getting long up at around 115, we've already got the advantage. Now if we continue moving on as we started 2011, you can see that not only was it a really good entry back here, but you had a really nice amount of momentum to follow all the way until we got to March. Then you can see right here that it began to peak. We had our gap lower, but still, if you're just following this 50-day moving average and it's still going up, it wasn't until here that we started to see things getting a bit dicey. So assuming now that had you bought with us back at 110 here and rode this all the way up, you finally would have gotten out somewhere under around 130, and now you have had a $20 move in the S&P, just tracking the phase change and not waiting for the bullish phase, but getting in before that. Also, it gave you a good opportunity to get out here, but you wouldn't have necessarily gotten short because we were still in a relatively positive phase. I had mentioned to you earlier, warning is the next step to possibly get out of a bullish phase, but it's certainly not a reason for you to necessarily take a long-term position short. Now, as we continue into 2011, we break that 50-day moving average, and you can see here I had mentioned to you about slope, how I found slope to be an extremely important indication. So not only do we break the 50 again, but look what's happening. The distance between the 50 and the 200 now is starting to decrease. Number one, the slope on the 50 is starting to decline. So now you can see what happens here is we break the 200. The market has now gone from a bull phase, warning phase, back to a bull phase, now into what we call a distribution phase, because you can see that it's broken the 200 here, and then you have this big move down. Now at this point we would have been looking for short opportunities, and again, depending on the type of trader, whether you're looking for shorts just for a quick momentum, several days type play, or if you're looking to be a swing trader from the short side, at this point, if you started selling it here, you had until really basically you had the death cross here, you were already short. If you had waited for this death cross, you would have first been getting short down here, you would have gotten killed. But if you had gotten short just based on the fact that we are now in this negative phase and you caught this move down, there's a good chance that riding a move from 125 down to about 110, which if you recall was where we originally got in back in 2010, would have been reason for you, for at very least, to protect your profits on the short side. Certainly, you wouldn't have been starting to get short down here. And now, as we continue in time here, of course, as you know, in 2011, come the summer, this also happened to correspond with the U.S. downgrade. We really basically stayed in a range. We broke it ever so briefly, and then back in October, when we had this peak low, this is when we started getting interested in the market again. I began this day by telling you that you can make money in whether or not the market is going up or down, and that if you have been a buy and hold trader, you can see that in terms of where the S&P was many years ago to where it is now, you've gone nowhere. But you can also see that if you understand the phases and how to trade the phases, and you know how to limit your risk, there has been a lot of money to be made, and that's just looking at absolutely one ETF and one index, and that is the S&P 500. You also can see that we would have avoided any big losses. In fact, most of the gains would have been very big winners. And so it is extremely important to have these set of rules and to have this understanding. And this is exactly what our Complete Swing Trading System course teaches and does for you. So I just want to show you how, once again, using a phase change after this big crash in October, we decided to get long once we saw the price action and a couple of things that I had talked to you about already get back over this 50-day moving average, and you can see what's happening here. The slope on the 50 is starting to increase, plus the price action isn't that far away, so we have a very controllable risk, because if we're wrong getting long in these levels, we know we're going to get out if it does indeed break the 50-day moving average. So once again, now new long positions are established at 120. You can see what happens, that based on what we know, considering we're buying in a recovery phase and we needed to now get back above the 200, it does indeed do that, but only for a couple of days, and so our stop right here, once it broke under that 200-day moving average, would have been at around 125. So we had a quick momentum from 120 to about 125, and once again we get flat the market. In fact, we start thinking about a negative bias. Why? Because now we go back under that 200-day moving average, we can't clear it, and indeed we once again break the 50-day moving average. But had you been a seller here, if you were somebody who likes to short, you had another good momentum move down, otherwise you at the very least would have known it was time to get out of the long that you established back in here and stand aside. And then you can see this is where a lot of people coming into the end of the year started to get chopped up, because we had this bottoming formation. We got back over the 50, but we never took out the 200. So if you strictly wanted to trade the next time going long as we started a new year, 2012, and you wanted to trade a positive phase, but wait long before the bulls got in when we got back into a bullish cross, which you can see happened here as we ended January, just based on following our rules and understanding risk and reward and understanding how to use these phases and trade them powerfully, and again, whether you're a part-time trader, a full-time trader, a short-term trader, or a swing trader, your longs would have been established right here once we got above this 200-day moving average and we started to clear it. So at around 126. And you can see, as of the day that I'm making this video, the S&P 500 is now trading at 134.82, so you have already gotten nearly a $9 move just on the basis of this. And in terms of how you would exit, well, that is exactly what we teach you when you take the course. Now I'd like to take you through a stock that I had recommended in my end-of-year phases and forecasts, and how we started 2012 if you were completely flat with an opportunity to get long this based on everything I just showed you and what we learned in the course on phase changes, and that is Harley Davidson. So you can see right here is where we begin 2012. Let's say you had never even looked at this trade before or were completely new to us, and now you're working to get in on the best situation, which is a phase change, as I had told you very early on in the video, is the most powerful time to get into a stock. So here you are over the 200-day moving average. Now, based on what I had shown you before and the type of parameters that I like to look for, besides just using the 50 and the 200, is the distance between the two relative to the price. You can see the distance was extremely narrow. The slope, which on the 50-day is now up, sort of neutral to slightly down in the 200. And then how far the price action is from the moving averages. In this case, where you would have been signaled on your long right in here, or at around 38.50, your risk to under the 50-day moving average, which is what you have had to use to determine where your stop loss is, was only about $1. Now that dollar is exactly, if you look up here, what the range of this stock generally is on average. So if you got in at 38.50, your stop was at around 37.50. Most of you out there, even with the smallest trading accounts, can afford to risk $1, especially if you know how to position size correctly, and that is something else we cover in the CSTS course. So now look what happens from there. Continues to go up without any pain whatsoever. And here we are on the day that I'm making the video. We had a high price here of about 47. If we got in at 38.50, we're talking about nearly a $9 move in a stock in just 6 weeks amount of time. That is the type of risk reward that any trader would love to have, risking $1 to make 9. And that is precisely why I'm telling you that this is what the CSDS course will do for you. Show you how you can not only make money whether the market is going up or down, but also teach you when you have these type of controllable risks and great lines in the sand for you to have your stop loss in, you can begin to feel comfortable taking your positions home. You can feel safe. And if you're not trading with a lot of money, risking $1 on a stock that is not overly expensive like a Google or an Apple also will make you feel safe and begin to help you build your account up. So it is that I leave you with, for you to understand that if you have a systematic approach and you use discipline and you understand phase changes and you understand your risk reward parameters, you can become an extremely successful trader. Thanks so much for listening. Have a wonderful day, and bye for now.